Most people turn to bonds when rates drop, but smart investors know there's much more to consider. We expect the upcoming US rate cut cycle to be more consistent with a soft landing scenario, but what does that mean for investors and the broader economy? The US Federal Reserve has begun its rate cut cycle in September, and we expect policy rates to reach 3% by the middle of 2026. Historically, when the Fed cut rates and the economy avoids a hard landing, risk assets such as stocks and corporate bonds tend to perform well. Why is the Fed cutting rates now? Well, there are two main reasons for the Fed's shift towards easing monetary policy. First, the job market is showing signs of slowing. Non-farm payrolls of the recent months have been weaker than expected, with unemployment rate rising from a low level. Other indicators are pointing towards weaker hiring by companies as well. Number two, the Fed believes that the inflationary impact from tariffs will be temporary. Recent data shows slower inflation in rent and services, and also falling gasoline prices. That helps to keep headline inflation steady. Now let's look at how different asset classes have performed after previous rate cut cycles. Now this chart shows the performance of equities, fixed income, gold, and the US dollar 12 months after the first rate cut. In tough recessions such as 2001 and 2008, equities struggled due to sharp market corrections. In more moderate slowdowns, equities generally saw positive returns as the underlying growth remains intact. Fixed income returns were steadier with lower volatility. But this time, household leverage is modest compared to pre-2008 levels. Even though equities valuations are high, the tech companies leading the current rally are actually very profitable, unlike in 2000 dot-com bubble. While equity markets also go through short-term volatilities, we see the current scenario to be more consistent with a soft landing instead of a hard landing, and hence supporting risk assets. So what should investors consider? A globally diversified, active allocation remains important. A weaker US dollar should support emerging and APAC markets. Technology and communication sectors look strong, driven by global AI development. Short duration fixed income may benefit from lower rates, while longer-term bonds could face challenges from fiscal concerns. Lower interest rates should help to keep default rates manageable and hence supporting high-yield corporate debt. A weaker dollar may also boost emerging market fixed income. So in summary, the expected rate cut cycle should support risk assets and extend the US economic growth cycle, but with uneven earnings growth and global uncertainties, a well-diversified, active approach remains key. For more insights, please visit our website at JP Morgan Asset Management and look for market insights.